Hello everyone, Professor Christensen here. In this video we're going to practice using debits and credits to record accounting transactions. If you haven't watched the previous video about debits and credits or you don't know anything about them, you might want to take a look at that. So let's see, if you're in my class you probably have copies of these exercises. If not, no problem, you could just follow along. Okay, so in our first exercise, for each of these account categories, we're going to decide whether a debit increases it or decreases it. All right, so hopefully you have our little hint, which is dealer. And dealer is that debits, expenses, and assets have debit balances, and liabilities, owner's equity, and revenue have credit balances. That was in the prior video. All right, so let's review. So an asset has a normal debit balance. So that means if you debit it, you're going to increase it. Let me make that a little bigger for you. Okay, so if you debit it, you're going to increase it. If you credit an asset, you're going to decrease it. Now, this is one of the things that gets students confused. An asset has a debit balance, but that doesn't mean that every time you debit or credit an asset, it has to be a debit. A debit simply increases the asset. Okay? So you can increase an asset or decrease an asset. So you can debit it or you can credit it. All right, so remember, liabilities are on the other side. So if you debit a liability, you're decreasing it, and if you credit it, you're increasing it. Okay? Remember, liabilities are also increased and decreased. So for example, if you buy something on account, you have a liability. You bought something and you owe the money, so you have a new liability. That would be a credit. If you pay off your liability is going down, and that would be a debit. Okay? Common stock and retained earnings are both credit balance accounts. They're on the, remember, the dealer, liabilities, owner's equity, and revenue. So these are owner's equity accounts, and they're on the right or the credit side. So a debit is going to decrease common stock, and a credit is going to increase it, and it's the same for retained earnings. A debit will decrease retained earnings, a credit will increase it. Now, dividends is a little tricky. Remember, with dealer, dividends is the first one that's over on the left. That's a debit. The reason dividends have a debit is because they decrease our retained earnings. Okay? So when you debit dividends, you're increasing it, and when you credit them, you're decreasing them. We don't usually credit dividends unless you're closing them. Okay? So these three accounts here generally only go in one direction. Okay? So that will help you. Assets and liabilities go up and down. Actually, common stock also generally only goes up. If you're in an introductory course, you're only going to be looking at increases in common stock. So let's also highlight that. So these four accounts, try to remember that you're usually increasing them. So you're issuing common stock, you're paying dividends, you're earning revenue, you're paying expenses. Okay? So these are generally going in one direction. Assets and liabilities tend to go up and down. All right, so let's look at revenues. So revenues would decrease with a debit, even though we don't usually do that, and they would increase with the credit. All right, if you're in an introductory course, the only time these are going to be different is if you're closing your accounts or you're adjusting them. Okay? All right, expenses are increased by debits, decreased by credits. All right, so this is our guideline now. We're going to use this and our dealer to decide what to debit and credit for each of these transactions. Okay, so this is like the next step in recording accounting transactions. So here we have some simple transactions. Also, when you're reading these problems, this particular one tells you the names of the accounts that they use. So you have a very limited number of choices here. We only have 1, 2, 3, 4, 5 accounts. Okay, so it has to be one of those 5 that you're debiting or crediting. All right, so the first thing that happens, we purchase a truck and sign a note payable. So what I would recommend, think to yourself, what two accounts are being affected? So let's look at the bottom, purchase a truck, and down here they tell you to use equipment for the truck. So the two accounts we're going to use are equipment, and it says signs a note payable. So that means note payable will be the other account that we're going to use. All right, so first decide what two accounts. Now, do we debit or do we credit? Which one's debited, which one's credited? Okay, equipment is an asset. Now, if you're not comfortable with what kinds of accounts are in which categories, you need to go back and study that, because that's like the building block for this, okay? So equipment is an asset. We know that assets go up by debits. So we're going to debit equipment for $15,000. All right? And we know that if we have to debit equipment, of course, we have to credit note payable. But why are we crediting note payable? Because note payable is a liability and it's going up, right? We have a new liability we didn't have before. So we're increasing our note payable. Okay? All right. So, and if you're stuck, and remember, you know, there's always going to be, in this case, there's one debit and one credit. So if you know one of them, and you know the other account, then you can kind of back into the other one. But it is better to understand why you're debiting and why you're crediting. Okay, next up, purchase office supplies for cash. So let's take a look at this. Office supplies, let's look down here. We have an account called supplies. So supplies is going to be one of our accounts. And what is the other account going to be? Well, they give you the words. They don't always give you the words, but in this case, they give you the words. So cash. Okay. So supplies and cash. Now, here's a case where we're dealing with two assets, okay? Supplies and cash are both assets. So that must mean one is going up and one is going down. So you bought office supplies. That means office supplies are coming in and we're increasing our supplies. If you increase an asset, you debit it, okay? So debit supplies. And then cash is going to be credited by process of elimination, but also, why is cash being credited? Cash is going down. And I put little notes in here to remind ourselves, right? This wouldn't be in your journal entry, but this is just to remind you. This is going up, so you debit it. This is going down, okay? In this case, both of them were going up. Equipment went up because we bought it. Note payable went up because we have a new liability. All right? Okay, next. We pay $800 in rent for the current month. Let's look down here. Looks like this is going to be rent expense. And now what is the other one? So there's not another account word in here, but there is a hint for us. And the hint is pay. So you want to make a note. You can write this down. Pay or paid equals cash. Right? If you pay something, then you used cash. Cash is being credited. All right? Cash is being credited if you see paid. So that's like a little hint. All right. So here, rent expense is going up. Remember, we said we usually debit expenses. Rent expense is going up. So we're going to debit it. And cash, we said, is going down, so we're going to credit it. And remember that paid, that will help you, okay? All right, next up, let's do one more to practice our journal entries and our debits and credits. Okay, so we provided music lessons to students for $17,000 in cash. Now, if you have the time, what I would do right now is I would pause this video, take a couple of minutes, and try to write the journal entries on your own. Because the best way to do this is practice, and even if everyone is wrong, at least you'll be able to listen and you'll be able to figure out how your thinking is different than what I'm saying, so then you'll know what's wrong. So my suggestion would be pause the video, write your answers to these 4 journal entries, and then come back and play it, okay? All right, so here we go. Provide music lessons to students for $17,000 cash. Again, we're lucky in this case because we are given the accounts. All right. In real life, you're given the accounts also, but it's not just going to be a few accounts. You're going to have what's called a chart of accounts, which is a list of all of the accounts that the company has. But here we have 1, 2, 3, 4, 5, 6. We only have 6 accounts. All right, so let's see the first one. Provide music lessons to students. This is a music academy. It helps to look at what kind of business you're talking about. Okay, so we provided music lessons to students. Whenever you see provide or provided services, something like that, that tells you that you have service revenue. Okay? So let's put down here like we did for cash. Provide services equals service revenue. Okay? Providing services equals service revenue. That will help you to remember that. Here they say provide music lessons, and the music lessons are your service. So we have service revenue, and what is the other thing? Well, here's the hint. They gave you the word. So it's service revenue and cash are the two accounts that are being affected. Now, which one's being debited? Which one's being credited? All right. Is cash going up or is cash going down? Well, if you provided services to students, they probably paid you money, right? So your cash is going up. Oops, so you're debiting your cash. Let's put our credit in there. And we're going to credit service revenue. Notice that when I make a credit, I am indenting the account because that's the convention in accounting, right? The credit tells you, the indent tells you that it's a credit. Also, we always put our debits first and our credits second. All right, next. So this service revenue is also going up, and service revenue has a credit balance, so that's why we're crediting it. Okay? All right, next up, purchase prepaid insurance to protect musical equipment over the next year for $4,200 in cash. All right, what two accounts are we looking at? Well, it tells you purchased prepaid insurance. It's not always going to tell you that. They might say something like paid insurance for the next year, and they're not going to tell you that it's prepaid, so you might have to know that. But in this case, they're being nice, telling us that they purchased prepaid insurance. They also gave us the name of the other account, cash, right? All right, so what kind of account is prepaid insurance? Hopefully you know that it's an asset account. We have two assets. One is going up, one's going down. All right, so now you need to decide which one's going up and which one's going down. So if you're purchasing something for cash, generally speaking, the cash is going out, right? Think of your own transactions. You go into a store, you buy something for cash, you're paying cash, right? So in this case, prepaid insurance is going up. Okay, so we bought prepaid insurance for $4,200, and then cash is going down. All right, next up, purchased musical equipment for cash. All right, let's look at the similarities here. Musical equipment is an asset. We're buying an asset for cash. What did we do up here? We bought an asset for cash. Okay, so after a while, when you do a lot of transactions and you keep practicing your debits and credits, you're going to find that when somebody says to you, purchase an asset on account or purchase an asset for cash, right away you're going to know debit, asset, credit, cash. Well, cash is an asset also, but it's a different asset, right? Okay, so purchase musical equipment for $20,000 cash. Let's look down here. What are our accounts we're going to use? Our equipment and cash. Again, one asset going up, one asset going down. Our equipment is going up, $20,000. And our cash, because we bought the equipment, is going down. Okay. All right, last transaction. Obtain a loan from a bank by signing a note for $30,000. All right, so you obtained a loan from a bank by signing a note for $30,000. So there's one little hint in here as to what account we're going to debit or credit. So we have to think about this. If you get a loan from a bank, what does that mean? What did the bank give you? Hopefully you're thinking cash, right? The bank gave you cash. So it doesn't tell you cash, and this is the trick with the journal entries. You have to practice them a lot so that you recognize what the accounts are that are being affected. And that's really the hard part, okay? All right, so we got a loan from a bank, so our cash is going up, and it says we signed a note. We signed a note. All right, if you look down here, notes payable, right? So you signed a note. Notes payable is our other account. The note tells the bank, I'm going to pay you back this money in a certain amount of time, and it's going to have some interest with it, right? All right, so what's happening to our cash in this account, in this transaction? Our cash is going up, right? We're getting cash. We're getting cash from the bank, so our cash is going up. And also, our note payable is going up because it's a liability that we didn't have before. We owe the bank money, and we didn't owe the bank money before. So we have a new liability. Our liabilities are going up. Okay? All right. I hope you found this helpful. Thank you for watching, and good luck with your future accounting studies.